A new monetary instrument, stablecoins, were created to facilitate buying and selling cryptocurrencies, but are now being increasingly adopted by banks and financial institutions. Are they the next step in the evolution of money, or just another type of headache? I'm Tomasz Koper, and this is Connected on Taiwan Plus. Could you briefly tell us what stablecoins are and what functions do they serve?
Stablecoins are digital tokens designed to keep a stable value, usually pegged one-to-one to a currency, like the US dollar, unlike the Bitcoin or other cryptocurrencies. The prices fluctuate a lot, but stablecoins try to minimize the volatility so they can function more like the digital cash.
Stablecoins came about as a supportive tool for the crypto market, but they are now entering mainstream consciousness, mainstream conversations. What is causing that?
Yeah, that's a great question. We're starting indeed to see more institutional adoption. That means banks themselves are starting to use these same payment rails that originally came from, what we would call crypto bros, kind of a pocket of the financial system that people didn't take quite seriously.
Another term that we often hear in association with stablecoins, or often in the same sentence, are CBDCs, or central bank digital currencies. How do they differ from stablecoins in their origin, their issuance, and how they're used?
The main difference between them, I think, CBDC issue the digital currency. We will call the legal tender. But stablecoins are issued by the private entity, typically backed by reserve. So CBDC will focus on the public policy goal, but the stablecoin will focus on the market-driven utility and innovation.
Stablecoins are a quickly growing phenomenon, but just how big will they get in the coming years? Well, the stablecoin market went from being worth less than $10 billion in 2020 to breaking $200 billion in 2025. Estimates for 2030 range from a conservative $500 billion, or bear case, to a whopping $3.7 trillion in the best, or bull case. Chien-Ping, I know that you are pretty optimistic, pretty bullish on stablecoins. What makes you so optimistic about the future of this new tool?
I'm optimistic because the stablecoin deliver measurable efficiency.
Cryptocurrency rails, the blockchain network typically is much faster than the existing networks that we have today. For example, settlements on SWIFT may take 2 to 5 business days, but payments using stablecoins can settle in seconds or even less than that, depending on the types of network that you're using. As a consequence for the speed and some of the legacy, just for a reference, the SWIFT network was put together in the 1970s. That technology is still in use today, 50 years old. Right? So there's a tremendous amount of legacy. There's some transaction fees there. Traditional remittances that get sent cross-border have fees anywhere between 1 to even like 10%, depending on the country that you're sending in or receiving from, because there may have to be many different hops along the way.
Well, Chien-Ping, we know that stablecoins don't come in just one variety. In fact, there are 4 main kinds. Which one of the 4 do you think is most likely to see widespread adoption?
The first one is the most popular, we call fiat collateral stablecoin. Tether issued the first stablecoin in 2014. And the second type is we call crypto capitalized stablecoin. It's supported by the Israel. We call the DAI. And the third kind is algorithm. And the last type is the commodity backed. Usually it's supported by scarce metal like the gold. In the future, the mass adoption, the fiat backed tends to win.
We use the term stablecoin somewhat liberally now, and it is good that we have now more regulatory frameworks to think about what does it take to qualify as a well-regulated stablecoin. Across the 4 different types of stablecoin, really, there's only one that's provably stable, and that's exactly the one that Professor Chung mentioned, the one that's fully fiat-backed. The other types of stablecoins are ways to try to generate yield or try to get some more efficiency without quite backing everything all at once. And that actually makes stuff slightly more risky. We've seen some of these stable coins blow up, and unfortunately, many of them that blow up were not the ones that were fully fiat backed. And that what happens is that gives the entire stablecoin market a pretty bad reputation. So we should think a little bit about the terminology, and having the regulation in place is actually a positive thing.